our next guest. He's Mike Thompson. He's Global Head of Research for Standard & Poor's Evaluation and Risk Strategies. Mike, thank you so much for coming in the studio.
Thanks for having me.
There's so much talk about, of course, how much of an effect this quantitative easing can have, and the risks seem really real if, in fact, it just pushes global imbalances higher and it forces a currency war across the globe. I mean, are you for QE or against it?
Well, I think it's really what the market is for. It's funny because there's a lot of different constituents in the market. I think, in effect, if you hear a lot of monetary authorities over here are probably more against the U.S. easing. It does potentially bring in the notion that you could have the importation of inflation. Obviously, the dollar has already, felt it. 600 billion, 75 billion over in monthly installments. It's not overly aggressive. I think, the bond market itself, participants we talked to, some of them wanted more. But I think there are other people, there's another camp out there that says, well, we keep doing this, are we just prolonging something that we need to get out of?
And that will be harder to fix, down the line, 6-7 years from now. How do you get all of this, the life support out of the system?
That's right. Well, look, here's the situation. You have this somewhat anemic 2 to 3% growth track in GDP. At the same time, you have, the core PCE deflator, which is widely looked at in the United States at the level that hasn't been at since 1998, which was the last time that the policymakers were worried about the importation or deflationary environment. So it's really this inflection point. Kind of a sagging housing market, it just can't find any legs. So it's really kind of an inflection period of time here. But I think at the end of the day, this is not going to be a big deal in about a week. It's going to be something that happened.
Mike, you're Global Head of Research at Valuation and Risk Strategies. What is your #1 risk that you're seeing out there, which possibly you didn't foresee just 6 months ago?
Well, I think the risk we're starting to zone in on is effectively where's the next bubble. And, you have a lot of cash out there. You have a lot of companies are well engineered. And I think, interestingly enough, if you look on a more long-term basis, markets move in bubbles. We've had a bubble. We had the dot-com bubble became a real estate bubble, which then became
financial bubble.
Yeah, and now the question is, where's the next bubble?
Where is it? You have to tell us, Mike.
Well,
where do you foresee it?
I think you're probably going to see. I think there's good news. I think for a while you could see the equity markets really get a benefit from all this, and I think the potential would be for somewhere down the road that the equity markets could be the bubble. I mean, I'm not saying the valuations are all that, rich on a historical basis in equities, but the bottom line is that there's been a realignment in kind of what earnings are going to do and things like that. So I think that's really what our biggest risk is trying to identify where the bubble is. We sort of think that the potential it could be in equities, but I'll tell you.
And this is across the board, U.S., Europe, emerging markets?
I think it starts in the U.S. But, the only thing I will say is that fear we're watching closely because it ties into M&A, and M&A is kind of a mixed bag right now, too.
Now, Mike, hold that thought because we'll get back to you in a second. But Ireland faces a messy month ahead of its national budget with the risk it won't be ready in time. Well, concern about that and the cost of its bank bailout is causing a steady sell-off of its government bonds. Now, the spread between Irish 10-year securities and German bonds has widened. And, of course, the more expensive that debt becomes, the harder it will be to secure essential funding. Now, there's a similar trend underway in Portugal and Greece. At least the prospect of higher interest rates are receding. So, Mike, if you look at that, I know just 6-7 months ago we were still worried about what Greece was doing, what Ireland was going, and actually a lot of investors say we're just not thinking about it, but there's still a potential that some of these countries will default 3 years down the line. Is that your take on it?
Yeah, I think from a valuation risk strategy point of view, we tell people to keep stress testing. We're not through the woods yet. Look, the market's saying something. I mean, at least Portugal got some relief from the investment community because I think the investment community took seriously the efforts being made down there at, some austerity moves. I think, bank bailouts in Ireland, immediately you saw the investors' response to that and Ireland's, spreads start to widen out, particularly in the CDS market. So
are we looking at a default?
I'm not going to say that. You know, I'd be only conjecturing.
Yeah.
I probably think that's less likely now, but I would say is that I think it's not that there's a smooth highway in front of us.
Mike, how concerned are you? You know, the Fed is pouring all of this money into the economy. Now, it puts the UK, but also the European Central Bank in a very tricky situation because they're talking about exiting, but when you have such a strong economy pouring liquidity, will they have to face up and do the same, or do they not?
I think we've been, you know, in the marketplace, we've kind of gathered this, that at the end of the day, the ECB would likely err on the side of conservative accommodation. The problem they have is that, you know, Germany has very strong business indications for their economy. Their unemployment is, I think, as low as it's been since 1992, you know, at 7.5%. So, you know, it's harder for them to make the case that you need a lot of easing. But again, it does create this kind of imbalance because you have so much aggressive, relative to the U.S., they're way behind the curve. And I think, you know, the question is who's right. And I think that probably the truth is in the middle like it always is.
Mike, thank you so much. Mike Thompson there.